Hello, I'm Ralph Benson, co-founder and head of financial advice at Moneycube.ie. With me today to discuss index investing into equities and bonds is Barry O'Leary, Vice President at State Street Global Advisors, or SSGA. SSGA is one of the big three index fund managers with a presence in 30 countries and over 4.7 trillion euros in assets under management. In Ireland, SSGA are available for pension and investment savers via New Ireland's platform, and those are the funds we're going to talk about today. They're also available direct to investors as part of larger investment portfolios. Barry, you're very welcome to the discussion. You're based here in Dublin, but the funds are very much global in nature. Perhaps we could begin by understanding your role and the SSGA team that work on the index fund range available to Irish investors.
Absolutely, Ray. First of all, thanks for having me on today, and thanks to anybody who has or is considering investing in the funds. So in terms of my own role with State Street Global Advisors, I look after the New Ireland relationship. So I act as the link between SSGA and New Ireland. So I'm responsible for kind of bringing our investment capabilities to what New Ireland clients and what the financial advisor and broker community and then investors need in the Irish market. That entails a lot of work in product development and also marketing. That's me based here, but as Rafe said, the firm is very much a global firm, and the team behind the funds, while we have some people based in Ireland, they do leverage our global investment platform. So, across Europe, in the States, and also in Asia, we have people involved in managing these funds. And then, just stepping back a little bit further, I suppose, it's, as Rafe said, it's a huge financial organization. It's one of the largest financial services firms in the world. That kind of sounds like boring and irrelevant information, but what I would say is that, you get a huge amount of regulatory scrutiny, and that obviously benefits clients in terms of, security of conduct and assets. And also, the size and the scale does allow us to manage money very efficiently and in a very cost-effective manner. So, size and scale always sounds boring, but there are some real tangible benefits for end investors in that.
Yeah, and I think we'll probably come on to talking about that, Barry, in the context of that's particularly the case with index funds, I guess,
Absolutely.
where tracking large liquid markets a lot of the time.
Yeah.
So that makes sense. So I guess we're here to talk about the prime range, which sits on the New Ireland life assurance platform. So maybe begin by telling us, they kind of there's a range there from kind of lower risk, lower return posture funds to higher risk, higher return funds. So maybe give us a sense of what that range is and how it's put together.
Yeah, sure. So there's four prime funds, and as you say, they vary from low to medium to high risk. So your lower risk fund would be called Prime 3. And that would have, maybe a quarter of the assets in equities, which would be seen as the most aggressive asset class. And then it has some other growth orientated assets like properties and alternatives. And then it has some what you would typically call defensive asset classes. Around half of the portfolio would be in cash and bonds. So you have a mix there of defensive and growth orientated assets. And as you move up the risk spectrum, as you go to prime 4, 5, and then prime equities, you gradually increase the risk. But obviously, you obviously increase the return potential as well. So as you go up, you have less in equities, more in equities and less in cash and bonds. And then the most aggressive funds is just invested in equities at all times. And that will give you also the strongest and best return over the long term. You need to be comfortable with that volatility, though.
Yeah. So maybe let's just focus in on that equity bit for starters, because I guess all of the funds have a chunk of equities. So
Yeah.
am I right to think, is it the case that the range of funds hold those same equities? It's just that they're held in different proportions, or hold those same assets, but they're held in different proportions depending on the risk orientation of the fund.
That's exactly it. All four funds would use the same building blocks. It's just maybe, the lower risk funds would hold more of the less risky assets, and the higher ones would hold more of the riskier assets. And then as you move up to the risk spectrum, some of them mightn't hold bonds and cash at all. So, they all use the same underlying building blocks. They're managed by our specialist index equity or index bond teams. Again, that's a benefit of kind of being with a firm of State Street Global Advisors. We don't sort of have, jack of all trades investment managers. They're very specialized in their area. So we have a dedicated team to managing index equity funds, a dedicated team to managing index bond funds, a dedicated team to managing cash, and then a dedicated team who brings all of that together and make sure that the portfolio has the right blend of assets, is sufficiently diversified, has a good risk management process in place, and essentially you're getting most bang for your buck in terms of the trade-off between risk and return.
Got it. Yeah. Okay. And so, like, we've kind of thrown that term index investing out a few times as if it's
as if people know what it means.
Yeah. So, and I've always found, like, I suppose what I say to customers is the two things you need to think about in terms of index investing, right? So it's like, firstly, what index are you following? Because in principle, following an index could be an awful idea if you're following the wrong index. And secondly, is your manager, SSGA in this case, is your manager faithfully following that index, and how do they manage that? So maybe if you could just talk a little bit about, what is an index fund, and how do we actually implement that in the context of a fund, in practice?
Yeah. So an index fund is essentially one that tries to replicate the returns of that specific asset class, right? And there's two approaches. There's index management, or what's often called passive investing, which I think is an awful phrase for it. And then there's active management. And if you were to think of the global stock market, if you were to think of the developed world, the global equity markets in that, as an example, Microsoft makes up around 4% of the world stock market. So what an index fund does is invest exactly 4% in Microsoft. And then if BMW makes up 1%, let's say, then the index fund will invest 1% of its money in BMW, so that the fund looks exactly the same as the global stock market in large, right? Now, what that means is that you won't beat the index, right? So if you see a headline which says global markets up 7%, then you should, in theory, your fund should also be up 7%. Now, what that means is that you're not going to get more than the index, right? And people will say, well, why would I do that? The harsh reality is that there aren't many active managers, so people who make decisions on which companies are better investments than others. So they might be overweight Microsoft or underweight Microsoft. People who use that active approach, many of those actually don't manage to beat the index, right? Now, I think there's a difference between just, somebody selecting an active manager and doing it with a financial advisor like yourself, Ralph, right? That does act as a screen and help people with choosing good funds. But by and large, index funds tend to be some of the best performing funds when you look at the league tables. They are always towards the top of the league table, and especially the longer you look out. So if you move kind of into a 5 and 10 year space, they tend to be, better performing than a vast array of active managers. And it also means that because you're not hiring, a whole team of research analysts and a whole team of portfolio managers, there are cost efficiencies to there. We do very complex and rigorous systems to make sure that we're tracking the index. And there's a lot of research that goes into making sure that we're doing it in the most cost-effective way and avoiding transition costs and reducing our dealing costs. But by and large, that's systematic and it's something you can really scale. There's a good cost base there.
Like, I like the way you said, passive is kind of an awful name for it, because there's nothing passive about index investing in a way. Like what I've discovered, there's a huge amount of brain power goes into making sure that you do faithfully track an index. the big one for me was when Saudi Aramco floated, was the world's biggest company by some measures. And that was a very challenging period for people who were running a passive emerging
Yeah,
markets index because, on kind of Monday, this company doesn't exist on markets, and on Tuesday it's the biggest company floated on the stock exchange, and how do you
yeah.
manage around? So it's certainly not the case that it's just this has been given over to a bot that can kind of replicate that index performance in a responsible fashion.
Yeah, yeah, absolutely. And I mean, that's the case in equity markets, where we have to actually anticipate, which companies are going to be added into the index and which companies will fall out of the index. And we need to kind of beat the market to that, because if you're selling a company that's falling out of the index and therefore shouldn't be in your fund anymore, if you do it on that particular day, there'll be huge trading costs. You mightn't be able to liquidate the position. So there is some anticipation involved in that. And even more so in the fixed income markets, it's actually quite sophisticated how we make sure that we generate the same returns. But on the fixed income markets, it's much bigger than the equity markets actually, and there's many more holdings. So how do we do it that we're giving you the same return but not trading as much as the entire index? So there
Yeah.
is a lot of thought and a lot of scale that is required to do this efficiently to generate good returns, but to minimize the costs for end investors.
Yeah. Okay. And coming back to, like, say, the prime equities fund, which
Mm,
effectively is the same as the equity component in prime three, four, and five,
yeah.
like, tell me about the indices that is following it. Is that a world index, or is it more than one index?
Yeah. So we have three different indices in there. The largest is what we would call the Developed World Index, and the name of that is MSCI. MSCI. I don't think that'll mean much to people, but it's one of the best recognized indexes out there, and that essentially tracks the developed markets. So North America, well, not Mexico, but Canada, US, most of Europe, Japan. So there's around 23 countries in that index, all very well developed economies. That would make up around 80% of prime equities, because that's generally the proportion of the global stock market that it represents. But then we also have two other indices in there. One of them is the emerging market index. So that's where you get exposure to Brazil, Mexico, China, a lot of the Asian economies. That would make up around 10% of it. Now, they're a little more risky than developed market equities, but concurrent with that risk, you also get a higher return potential because these emerging economies, as they're called, they have a higher growth trajectory. They're kind of catching up with the developed economies, in some ways similar to actually what Ireland would have experienced in the 80s. It would have been a laggard compared to the rest of Europe, and its growth trajectory was much stronger than the rest of Europe. And the stock market until 2008 at least did a lot better than the rest of the European equity market. So you're kind of buying into that emerging market growth story with those
Yeah.
equities.
And some very important regions of the world, right,
Yeah,
that just aren't
yeah.
captured in the developed market.
Exactly. Some very important regions and also some very important sectors. So, these emerging market companies or economies, they may not be geared into kind of the higher value tech sector, but they still have a lot of exposures that would no longer be in developed markets. So it's not just from a geography or from a growth perspective, but also from having your investments spread across different sectors, that it's good to have that emerging market
Yeah, definitely. And
exposure in there.
it's certainly like China appears to be the only region of the world apart from US West Coast that can produce kind of, those mega companies that will just
Yeah,
dominate their
absolutely.
sector. You look at something like Temu or something like that that just comes out of nowhere and
Yeah.
you
Uh,
know,
uh,
is
And I
huge.
think you might see that being the case increasingly with, India. If you look at, rising middle class in China, but also in India in terms of adoption of Western technologies and, cars per capita, all that sort of stuff that's increasing. If you're in an emerging market equities, you're kind of buying into that growth story.
Yeah, yeah. Okay, interesting. So that's So there's a developed market index and an emerging market index. Is there a third one then that you mentioned?
Yeah, yeah. So then there's what we call small cap or small capitalization. And that just means that these are essentially smaller companies. The market value of them isn't so big that it makes it into the main global MSCI index. And now when I say small cap, these companies, they can still be around a billion in terms of market capitalization. But what it means is that, a lot of companies now, their growth trajectory to some extent is reliant on, global economic growth and general increase in consumer spending. If you're buying into small cap uh, companies, you're more so buying into the organic growth of that company and that company still being in its growth phase, and not having kind of saturated its market yet. So again, it's just a little bit of a different dynamic, a little bit higher growth potential than your mainstream equities.
Yeah, it's really interesting because I guess sometimes you hear small and mid cap and and think, that this is a mom and pop type
No,
operation, but
no.
these are still going to be yeah, like reasonably kind of well advanced, but just might be in the key element of their growth stage.
Exactly. They're still listed companies. They still trade on a stock exchange. They still have to file their reports. They all have, well qualified CFO, CEOs, a board of directors. All that looks exactly the
Mm.
same as your typical PLC, just has still more growth potential or a little bit further
Frankly,
to go.
they'd be bigger than most companies in Ireland, right?
Uh,
Like
they
one
would
thinks
do
about
that.
it, there's probably a
Yeah,
handful of domestic companies that would even be big
yeah,
enough to fall into that index. So, okay,
yeah.
yeah, interesting. And I think particularly in the context of where we are recording this in kind of late Q1 of 2025, like there's a real interest in small and mid caps in the sense that mega cap technology has
Mm,
had a very good run over 18 months or more. There's a new focus in US markets on, I guess, America first and helping kind of
yeah,
domestically oriented businesses, which suddenly are finding, their European or Asian competitors facing tariffs. And at the same time, globally interest rates beginning to be cut a little bit. And those companies are the companies that tend to have debt-fueled growth rather than big cash reserves. So may find life a little bit easier in the kind of environment over the medium term. So it's a really interesting exposure within the prime funds.
yeah. The idea is that they're generally a little less sensitive to the general economic cycle, because their own growth kind of makes up more of their trajectory than just generally how the economy is doing. So somewhat ironically, the smaller stocks can be a little bit more insulated than the larger stocks.
Yeah, yeah. Okay. So we talk a little bit about some of the other classes then. I
Yeah,
mean, you've covered off the bonds and like you say, like bonds are the bond market is far bigger than the equity market, and is a core part of anyone's investments, particularly in the period approaching retirement, as they tend to
yeah,
become a bit more risk off and focus on say the lump sum maybe coming out of their pension and that kind of thing. So maybe say a word on bonds, and then probably the hardest bit to do as an index investor is to access illiquid asset classes like property and infrastructure and commodities
yeah,
and so on. So let's say a word or two on how the bond bit is delivered and come on to the property bit.
yeah, yeah. I think when people think of bonds, I think their mind automatically goes towards government bonds. So when people purchase government bonds from, European countries or the United States, and they're lending money essentially to the government, and they get at the moment a pretty decent return from it because interest rates are high, but heretofore has been relatively low. And then people may also be familiar with what's called corporate bonds, so where you're lending money to a company. Those companies are generally, can print their own money and don't have the ability to just raise taxes. You get compensated a little bit higher with the higher interest rate payment from those corporate bonds. So those are typically the two main bonds that people would be aware of, and we have exposure to those in prime as well. But I do think that over the last number of years, a lot of asset managers or a lot of investors maybe have not appreciated the full scope of bonds that are out there and the different type of bond markets that you can actually access. And what I mean by that is that, we have, as I said, we have government bonds and we have corporate bonds. But what we've done very purposefully over the last number of years is to invest in what are called shorter dated corporate bonds and shorter dated government bonds, because the interest rates those are paying are quite attractive. They're the same or more than kind of the longer dated bonds, where you get your money back in 10, 15, 20 years time. But they're less volatile. So you're getting the same amount of return, but with less volatility. And it brings, a higher level of stability to your portfolio while still generating a good income for the portfolio. And then we've also expanded into emerging market bonds. And again, it's a similar story to with the equities. You get a little bit of a higher interest rate payment because the growth trajectory is expected to be stronger. And, the currencies of emerging markets should also appreciate over time as people trade with them more. There's more demand for that currency. Just generally, as the economy rises, the currency will go up. So there's a lot of different bond kind of sub-asset classes, as we would call it, out there. And I think, again, without wanting to sound arrogant, that's one of the benefits of State Street and having that 4.7 trillion in assets under management. We have scale in these areas, and we have dedicated experts in all of sort of these more niche asset classes. And then we have that investment solutions group, which says, not just will we invest in government or corporate bonds, but, exactly which type of bonds and what other bond markets are out there that we can explore to improve that return potential of the funds.
Yeah, because I guess it's kind of looking euro for euro, what the risk-adjusted return you're looking for. And, if you can get that same return by taking less risk, that's obviously a huge benefit to your investor community.
Absolutely. And, you've kind of hit nicely there in terms of how we actually go about constructing the funds, which is actually, the first part of the process is assessing which assets rank best on a kind of euro for euro, how much return are you getting per unit of risk? And that gets put into a quantitative process in terms of, what mix will generate the best return? How do these assets interact with each other? Is there a sufficient level of diversification? And that then kind of gives you the best sort of balance between not having too risky a fund, not being exposed to one single asset class too much, but getting a really good level of return. Or, if you're taking a prime 3, a prime 4, prime 5, or prime equities, it's all about how do we get the most for the investor that's choosing that fund.
Yeah. Okay. And then maybe just like briefly on that topic of what's in the fund, then there's a few other asset categories in there, are there, Barry?
That's correct. Yeah, alternatives, as you mentioned there a while ago. So, what are alternatives? I guess it's the alternative to what we've already talked about in many ways. It's bonds, equities, and cash are often referred to as the traditional asset classes, and anything else outside of that would be alternatives. So that can be property, for instance. So we have a 8% allocation to the New Ireland Property Fund, which is also managed by SSGA. That's in prime 3, 4, and 5. Prime equities has no property exposure; it only holds equities, and that invests in commercial property, direct property holdings across the Ireland, UK, France, and Netherlands. That's in offices, in retail, and in logistics. So again, very well diversified, even within property. That gives you a nice rental income. So again, you're getting kind of a different return profile through rent roll as opposed to just capital appreciation.
Yeah.
And then other alternative asset classes are commodities. I think people will be familiar with oil, gold. Those are very attractive because typically when inflation goes up, those are some of the asset classes that will do the best. So it's good to have them in the portfolio. And then, lastly but not least, there would be, a relatively modest exposure to what we would call infrastructure, toll roads, bridges, airports, anything that has a relatively stable income, that's backed by a physical asset and where you're collecting income on that.
Yeah.
We
And
wouldn't be investing in,
oh,
yeah,
sorry.
sorry.
Well, I was just going to ask you what you wouldn't be investing in, so perhaps keep going.
Yeah, well, I mean, obviously we said that these are passive funds. So how can you, kind of buy bridges and roads and airports on a passive basis? We don't buy the physical assets. We buy companies that manage these assets, and those companies then have a very stable inflation-linked return, because they're collecting these tolls, and the operating costs are pretty steady. So it kind of replicates having the direct holdings almost. You're indirectly owning those assets by holding the company that owns those assets.
Yeah. Yeah, it's got to be right. Although I guess, typically property infrastructure, yeah, it's the most difficult thing to do within an index context. By
Yeah.
definition, there's a big human element, and these are illiquid, lumpy assets. So yeah, that's helpful.
Yeah.
I was gonna ask, I mean, like SSGA as a business now, like all of the major fund managers is, for example, producing crypto ETFs in the US and so on. So, like, if we look into the future of the composition of the funds, do you see that asset mix changing, or is that something the business is considering, or how do you think that's going to pan out in a European context where I guess regulators have been very slow to even allow those kind of assets within conventional funds?
Yeah. So I suppose maybe that just gives an opportunity to say that we do look at these funds on an annual basis, and we review them every year formally to make sure the asset allocation is still fit for purpose. And that then raises questions: what other new assets are out there that we can invest in, that are suitable for the fund? I think our view is that it's a little bit early to include crypto in portfolios like this yet. They don't have a sort of a reliable history. The history isn't long enough yet, and the asset is just too volatile to be able to put in a portfolio like this because, as we say, like you're trying to get a good level of return for your risk, but the risk is so high that it would just distort the level of risk in the portfolios to have any sort of meaningful allocation. There also isn't really strong regulation around it in Europe. In the US, I will say we have launched some cryptocurrency funds, but those are very much for, if an investor themselves wants to gain that exposure, we'll facilitate that. People have done very well out of that, but I suppose we can't figure out yet kind of the exact characteristics and how it performs over different time periods reliably to include it in a risk managed fund.
There's no doubt, right? It's very difficult to, like we talked about, risk-adjusted returns.
Exactly.
So if you
Yeah.
boil it back to that kind of principle, and say that if the prime 3, 4, and 5 are targeting particular levels of volatility and so on, there's no doubt that any serious crypto exposure could run a coach and horses through any of those plans.
Yeah, exactly.
Okay, so I think we probably need to wrap up soon, but I suppose the one thing I wanted to just touch on as we do is the concentration risk and concentration fact. Like that's just a feature of markets over the last little while, where we've been particularly the US megacap technology companies and perhaps a couple of other similar companies, pharma and so forth. We're at a period where I think you need to go back to the 1980s to find a period where there was so much of the stock market was invested in so few companies. And I guess for us as advisors, that presents our customers with a question around, it's not that, many of these companies aren't brilliant. They're obviously world-beating companies with great growth prospects and great growth histories, great margins, and products and so forth. But I suppose the problem is that they risk all getting hit at the same time with the same. For example, if there's a reassessment of the optimism around what artificial intelligence can do, then several of the biggest companies at the top end of index funds are likely to be affected. So I'd be really interested to hear your thoughts on, how index funds kind of work through that risk, if you
Yeah.
like, some of the benefits of being in an index fund in that context because of the fact that you do have whole of index exposure.
Yeah, there's probably two or three strands to that, and I think it's very relevant. When the latest AI app came out of China, DeepSeek, you actually saw that where a lot of the American tech companies, kind of the valuations fell on an initial basis. So you're absolutely right to talk about that. If we look at a kind of risk at an overall level, we do manage the what we would call the equity risk in the fund by monitoring how volatile markets are, right? So how bumpy are markets? How frequently are they going up and down, and how big are those gyrations? And if that spikes significantly, we actually reduce the equity content, because when kind of volatility increases, so when markets get a little bit more unstable, that's normally indicative that there's a higher proportion chance that markets will fall. And as a result, we kind of try to protect investors by reducing the equity content until things are a little bit calmer, and then go back into equity markets. That's all done on an automatic and systematic basis based on 20 years of equity market research. So that's kind of, generally a risk management approach about, your equity exposure, which I think is relevant in that. I think the other part of an index fund, the concentration risk, looking at the top holdings, is very valid. What I would say is look at the top 10 holdings 10, 15 years ago, and you will not see Apple, Microsoft, well, Microsoft you would, but you wouldn't see Apple, Meta, Nvidia, you wouldn't, Tesla, you wouldn't see those companies in the top 10. And if, you hadn't had an index, you may not have had exposure to those funds. So an index fund, while you are then exposed to the largest holdings, you are also kind of automatically buying in to the next growth story, to the next emerging technology, to the next sector, which, quite frankly, we may not even know is going to exist.
Yeah, absolutely.
I think
So
people say,
you
sorry, go on.
you own them on the way up as well.
Exactly.
Well, we want to be
Yeah.
focusing on that kind of top 10. It's that kind of long tail that, as an index investor,
Yeah.
you've already got a piece of it. And as you say, like, if one, thinks of, I don't know, a business like GE, it was at the peak of its powers around the
Exactly.
turn of the millennium. It's a shadow of its former self.
Yeah.
And by the time you and me are drawing down our pensions, I guess it'll be another bunch of companies in that top
Yeah.
10.
That's exactly it. And I mean, if you look at it in terms of the whole index as well, another part of that is, and GE, you can probably make the case in terms of how important electricity used to be, and how dominant they were in that space, and then how they grew out of that. But those companies are obviously geared into kind of selling their AI tools, right? So they're exposed to AI becoming cheaper and then not being able to charge as much. You got to think about what does that do to the rest of the companies that are out there. They then have a tool essentially, which is important to them at much lower cost, which will increase their productivity and their revenues. It's like if you were to think about oil, if your largest company in the index was an oil company, the price of oil falls, well, that's bad for that companies, but all the other companies will do well out of that. So that's your automatic diversification that you have in an index as well.
Yeah. Okay. It's really good. It's been a really helpful conversation, Barry, to get a sense of the fund range, how the index investing is being done, and to learn, I suppose, that there are kind of human beings doing this rather than a plane on autopilot.
No.
And to get a sense of kind of where we are in markets just now, and some of the things that are going to affect it into 2025. So I really appreciate your time. Thanks a lot, Barry.
Okay, thank you. Thanks. Appreciate the time, Ralph.